I mean, that's a great way to start, right? And especially over the last 6 months when we think about SPACs and crypto and tweets from Elon Musk and things like that. And stocks that have great stories, I think, have outperformed, right? Whether the fundamentals back that up or whether some extrapolation of the current fundamentals 5 or 10 or 15 years out. That's kind of the environment we're in. But I don't know, Jeremy, what do you think right now?
Well, some of the stuff I've seen appreciate a lot year to date have been things based on the promise of
Right.
going back, reflation, people go, post-COVID world, but the earnings aren't there and the growth hasn't actually happened. But it's based on the idea that this older economy business or traditional business will someday grow again, a cyclical business, but a lot of times they just haven't. But the stock has reacted as if it's happened.
Yeah, I mean, I think what's happened is there's been I almost call it like an evolution in value investing. A lot of the traditional buy the cheap stuff that isn't growing isn't working, and I think there's a fundamental reason for that. When you look at what you should be paying for a flat or declining business should be really low multiples, and what's being more rewarded now are situations where you actually have some underlying growth in the business and some operational leverage. I think those are two key things if you look for those in businesses.
And this is only a cycle. I mean, we've seen this happen many times in the past. And in fact, just over the last 18 months, what worked last year didn't work in the first quarter. And what didn't work last year has actually flipped around. And so the question answers itself if we just look back over the last 18 months.
It's really cyclical, like you're saying. It's really, and now it's interesting because you've seen some of the data now. The small cap value seems to be recovering.
Yep.
The faster growth is slowing down, but this is exactly what happened in 2000, right? You had a big growth period up to 2000. In 2000, the growth stuff slowed down, and then you had value taking off, and it's just sort of that constant.
Well, and the risk here, right, is that story can flip on its head.
Yes.
Yeah.
Right? So now all of these story stocks that have these, you can't even say multiples because it's not even really fundamental investing at this point. Mm-hmm. But you have all this optimism baked in, and once that turns around, you're going to get undue pessimism.
Yeah.
And that's when again you can find things that are just punished too far, and the story flips.
Yeah, you'll see like what happened in 2000. You had the tech names bid up way high, and then by 2002, 2003, a lot of them were really cheap. So it's really being able to, as a manager, I think, to really have the tools in your tool chest to really look at both types of situations and then be able to find values in both growth and traditional sort of value stocks. I mean, the other aspect of it too is that if you're looking at from a value investor from a traditional basis, a lot of times you're looking at just the price is driven by re-rating of the stock in terms of just getting a higher multiple on current earnings. But the advantage of looking at growth stocks is if you can get comfortable with the growth, you really get a combination of both, and it can make the job a little bit. You don't have to find as many re-rating opportunities if the growth is helping you along the way.
Yeah, and markets are so short-term oriented, and it's almost like markets are not designed to make long-term decisions.
Yeah.
And I think it's just a matter of time before, to your point, where kind of it flips back to more secular companies with a real secular tailwind.
Yeah.
And it's already happening, but this is just, the cycle just keeps going. And so longer term, the rewards go to people that can buy the right companies and just hang on throughout these cycles and just not worry as much about it. But the fundamentals need to be compounding during that time. It's fine if the stock goes down, if your higher growth business goes down in price because people want to buy a melting ice cube. It's probably appropriately priced, but bid it up out of fear of interest rates going up or whatever. You've just got to be able to hang on and not try to chase those things. I think that's that's kind of the way at least we approach it.
Well, ironically enough, I was just going to say my takeaway is you need to be more nimble. So,
Absolutely.
but I mean, I see your point. Ultimately, you do have to look to the fundamental. I don't think the market is appreciating fundamentals right now, but that's what we're all looking towards.
Yeah.
But for me, do you want to be nimble to how the market is through the stock price, honoring some of those fundamentals. So yeah, ideally you could ride your way through it, but that's just not happening in this market.
This goes back to Ben Graham's, famous statement: in the short term, it's a voting machine,
Yeah.
and in the long term, it is a voting
Never
machine.
heard of the guy. No. Does he exist today anymore? It's
There
crazy.
is actually a Ben Graham in Chicago.
Oh yeah.
Yeah, he is the head of a family office.
Of course, as he should be.
That's right. Yeah.
That's funny. I'll use this as an opportunity to plug. There's a Ben Graham memoir that everyone kind of knows in the investing space. They know Intelligent Investor and things like security analysis. But he actually has a memoir that he wrote himself that's fascinating. Gives a lot of background into him personally. I highly recommend it to anyone looking to learn more about the original Ben Graham.
Well, it's interesting. I mean, interesting phenomenon. If you guys have sort of seen, it's interesting what COVID has actually done in terms of the cycles of the business. Right, we were running pretty long in the business cycle before COVID happened.
Yeah.
And when COVID happened, it almost like reset the business cycle in terms of it was sort of a forced recession to a certain extent, right? And then now we're earlier on in terms of another cycle going up.
Yeah.
And it's interesting when I see, some people saying, okay, they're concerned about companies, especially like in housing, reaching peak earnings, and you just say, wait a minute, we just had a recession a few months ago. Is it really peak? I could see if we've been cranking along for a few years, but now it's really the question is, and you can look at businesses that can take advantage of that. The nice thing about like real estate is the cycles are so long.
Yeah.
And there seems to be a good amount of momentum, I think, in the cycle. Right now we're at, 1 million starts per year. Probably need to get 1.5 million over the next few years to sort of make up for the deficit that's happened historically. If you can find businesses that can take advantage of that, I think there's some real opportunity out there, because a lot of the businesses they're being priced on, this is the high end of the cycle, and I really question whether in real estate this is the high end of the cycle, because we're not even up to
We're not a replacement value, right?
replacement value at this point. Yeah,
And we were interrupted for an entire year.
exactly, and that interruption was quite severe, and basically and then right now, I think part of you can see that because of the increase in used home prices, right? I mean, existing home price, because there's a shortage. In essence, that's what's causing this thing. Eventually, the shortages will be reversed when there's more housing starts that happen. But is there a way? And there's some real interesting opportunities now in terms of companies that are very reasonably priced, that have really good growth prospects that could be tied to that.
Keith, is that just a U.S. phenomena, or do you see this happening in Europe and other markets too?
I've just focused on the U.S. I mean, it may happen in other places, but I think I just really see it in the U.S. is by far the biggest market, and the one where I think you've got some consolidation, especially amongst some of the building distributors and some of the other companies where that can happen. It's a consolidating, fragmented market, which is the kind of stuff that really lends itself to being able to get businesses where, as they consolidate, their margins get bigger, so you can really get almost a situation where if you can find a company with a low multiple, you think their sales may grow, let's say over the cycle, let's say it's going to grow another 50 to 60%, and you can just see the operational leverage just going to the bottom line, you can really get a lot of momentum behind that. And then you get some people who think that this is the top of a cycle, and therefore people are willing to sell. So you get a lot of these companies that have rebounded from the bottom, a bunch of people really willing to sell because they say, I made all this money, look at this, and I'm going to sell. But at this point, you look at it as a buyer and you say, okay, well, maybe I missed out on that big thing up, but looking forward, it still looks pretty good because we still have a little bit more to go in this cycle. And some of these businesses are just rolling along.
Yeah, well, look at us talking about fundamentals, right? The question was, do fundamentals matter? And here, I said no, and here we spent 10 minutes talking about fundamentals here.
Yeah,
But we talk about the disconnect,
Yeah,
from the
exactly.
market to the fundamentals, because ultimately things do snap back, to your point in the Ben Graham quote. It is a weighing machine over time, and it will get back to some sort of semblance of what the true value is. When that happens, nobody knows, right? So we're anchoring our analysis on these fundamentals, and then we need to figure out whether the market is, there's an arbitrage to it. Is the market looking at it the same way we are? And my answer to that is no. I don't think so. But we'll continue to do our work and find those opportunities there, good or bad.
Like I say, and I think it's really in specific areas. I mean, the market on average may not be hugely attractively priced, but I think there's pockets in there where you can find some really interesting opportunities and some real interesting trade-offs in terms of growth and valuation at this point.
I still find the U.S. market to be the deepest, most transparent. But as we have noticed over the last few years, particularly over the last 18 months, valuation in the U.S. has kind of moved up relative to the kind of quality businesses, quality business, quality management team, return generation. I find slightly more interesting opportunities in Europe. Europe, developed Asia, but primarily Europe. My biggest position is a Swedish online gaming company, and continental Europe. There are a whole bunch of names that I'm spending time on. Primarily, my thesis, my objective is to look for monopolists and oligopolists, good quality business, quality defined in terms of balance sheet, quality defined in terms of type of capital, internal versus external, and quality defined in terms of return generation. Some of these businesses are generating 30% return on capital for a long period of time, not just for 18 months or 24 months. And I find them to be more prevalent in Europe. UK for a period of time was a lot more attractive. I was spending a lot of time primarily driven, I think, by Brexit and everything associated with Brexit. I do have a position in a UK business in UK, but more continental Europe is where I'm finding interesting opportunities.
It's the difference in the way companies are run in Europe is really interesting. When you look at two high growth businesses or two tech businesses, one in Europe and one in the US, do you find, at least my observation, and maybe one of the big differences is the US company would be a lot more comfortable reinvesting 100% of the growth profit for very, very long periods of time, versus in Europe, depending on the country, you might see a tendency to back off and not be so extreme, and therefore cash flow will flow down more to the bottom line and the company will appear much more profitable. Versus the US company could do that, but instead they sometimes choose to just push the pedal to the metal and really, really try to accelerate, and ultimately was why you have these multi-trillion-dollar companies in the U.S. and what everybody's going for.
So is that a survivorship bias thing, though? Those that push the pedal to the metal did not succeed?
Maybe, yeah. I mean, it's just I think it's a cultural difference.
You hit on a very important point. I agree with you.
Some of my holdings, I look up and say, well, obviously, if they stopped reinvesting, they would just gush cash flow, and they would have an enormous amount of their earnings. They would look like they would have a PE ratio, but their runway is so attractive that the last thing they would want to do is pay tax. I mean, they have so many more interesting things to do, but in Europe and even in South America, you'll find companies that are very high growth with a long runway that even pay a dividend. But in Europe, you see this, and there's all kinds of reasons why they'll pay a dividend, because it's going to cover the wealth tax by certain large shareholders or whatever. But it's just a different way. And so I wonder, when you think about like what's more attractive, is it because of their approach towards capital allocation as being maybe a little less aggressive, and so they appear to be more cash flow positive or after tax earnings, whatever, versus the U.S. equivalent? You would have to reconfigure it and kind of say, okay, well, how is it going to look in 5 years or 10 years?
I mean, I've noticed that, like, for example, one industry you can see that in contrast is in the auto dealers. So in the U.S., you've got auto dealers that basically will not pay a dividend. They're growing because they're in a consolidating industry. They have a lot of targets, a lot of ways to deploy capital. In Europe, you have similarly companies, but the companies in Europe will want to pay a dividend. Yeah. And it's really tough in both auto retailing, value retailing type companies, and in auto dealers. I've seen the European companies want to pay a dividend and not put the pedal to the metal, like you're saying, in terms of growth. And it's more of a balanced approach. I mean, and I guess it really depends upon, what the growth opportunity is. I think in both these industries, there's a huge win for the guy that decides to reinvest as opposed to pay out. But it's like, and I wonder how much of it really has to do with their shareholder base, like you're saying. Maybe their shareholder base wants to have a dividend versus like the U.S.
Right?
But they need it. The tax, and there's different, Mercado Libre, for example, one of the highest growth companies I've ever seen in South America, in Argentina. They had a dividend for a long time. They recently canceled it. It made absolutely no sense.
Yeah, but they have limitations on buybacks there as well, right? So if they do have excess capital for a certain time period.
But a lot of the big tech companies, whether they're in Europe, it doesn't really matter. It's very much a global economy. So their business, especially the bigger ones, are not. They may be headquartered in the UK or Sweden or France or whatever, but they're competing on a global scale, and so. Compared to the U.S. equivalent, who is potentially, theoretically, investing 100% of their gross margin instead of choosing to make it more, I don't know.
Yeah, attractive. This is an argument, though, for U.S. equities and U.S. companies.
Right, and this is where I think the valuations come from. This is one of the reasons, I think, at least on the higher quality side, why the valuations look higher in the U.S. is because the opportunity is there. Kind of going back to what Jeff Bezos taught us all, looking at, Amazon in 2012 may have looked overvalued, but in fact it was one of the most undervalued companies in the market. And, like he's famous for saying, your gross margin is my opportunity or something, or whatever it was, or your costs are my opportunity, whatever it is. And, this ability to make really being founder controlled, being able to reinvest 100% of gross profits for 5 or 10 years out, ultimately paid off. And so the due diligence or the analysis you're doing on the business is very different from just looking at the accounting. You're really it's more of a business strategy investment or analysis. Looking at a business kind of like a private equity fund or a venture capital fund would look at it and trying to see where they are strategically going versus just saying these are the numbers in the past. And this is a difference in Europe, and it's not, doesn't mean necessarily that the European company can't compete and will not be achieve the dominant position or maintain it, especially if they're in a niche that they're really, really superior at and good at. But I think overall it begs the question of kind of defining the rationale for the multiples.
Right. But my point is, in spite of that kind of a dividend disease, I call it a dividend disease, in spite of having that dividend disease, I find some of these European companies to be a lot more attractive than similar type of businesses in the U.S. Another company that I am invested in is a Polish tech company. These guys provide live support, customer support. The name of the company itself is Live Chat Software. There are a number of U.S. players in the same space, HubSpot, Zendesk, LivePerson, but there are some very unique strengths to how live chat operates. There is no debt on the balance sheet. Management still owns a big chunk of equity, and because of their Polish presence, they've developed a large tech talent in Poland. In fact, until COVID hit, the country had not had a recession in 30 plus years. And so a phenomenal growth story, tailwind to the growth story, and fantastic tech talent. And they developed this technology where they were providing customer support to a number of different businesses, your housing companies, financial services, many in the U.S.
Oh yeah, I've used it. It's great. I mean, tons of companies I've going for online support.
And
used it.
They're able to generate significantly better margin, better returns than many of the U.S. companies. And a couple of different reasons. One, they have lower cost because their tech talent is all in Poland.
Right.
SG&A margin, if you compared live chats versus all the other U.S. players, about half of what it costs for the U.S. players. And many of the U.S. players are not making money. This is making money. And on top of it, they have this dividend disease of making 50% of their free cash in terms of dividend. But in spite of that, I find the valuation to be very attractive, any metric for that matter, on a sales metric, on a free cash multiple, on an EBITDA multiple. So yeah, I wish they didn't have I wish there was a panacea for this dividend disease, they would be even more attractive in that case.
Yeah.
But it's a fascinating story, and in fact, just to digress a little bit, I would be interested in your take. There is one country that seems to have figured out a solution to this dividend problem, which is Australia. Dividend is taxed twice. In the U.S., dividend is taxed twice, right?
Yes.
The company pays your dividend after making taxes, and you receiving dividend, you have to pay taxes. Well, in Australia, they seem to have answered it by having something called a franked dividend. When they pay you a dividend, the company has already paid a dividend, but they also give you something called a franking certificate, which you file when you file your returns, and you get credit for the taxes already paid. I wonder whether you've seen something like that in any other country.
Yeah, well, it's not going to
But
happen
that's
here. We know
digressing
that.
from Australia.
That's interesting.
Yeah.
That's interesting. I've never heard it called the dividend disease.
That's just
but,
my take.
I love it. I love it
is,
because
yeah.
you look at AT&T, for example. One of the reasons it led them to make so many mistakes is because they had to support this dividend, and they still, despite all their problems, they would rather divest some of their highest quality assets, media assets.
Exxon just gave up a couple of board seats. Similar story. They were making dividend not out of their operations.
And this is why when Dan Loeb went after Disney, he was so right, and it really unlocked a lot of value. And he said, "Why are you paying a dividend? You have so much opportunity for this free cash flow."
Well, you see the same thing happening in a lot of telecommunication companies. The large telecommunication companies killed themselves with dividend. They took on all this debt. They didn't invest in their future. So now you've got these small fiber guys that basically are eating their lunch, and their competitors have a lot of debt and they can't do much. So they're sort of hamstrung. They really are in a tough situation. Some of them have gone into bankruptcy as a result of it, and it really has to do with paying out this high dividend and not reinvesting in the business. And I think that the dividend culture in the extreme can really be deadly for companies, which is exactly what happens to a lot of the large U.S. telcos.
Recently, just last week, I spent some time with a Japanese management team.
Okay.
Fantastic business. They provide IR, investor relations, support for companies that are buying back stock and involved in some sort of an activist engagement. Just produces gobs of cash, but they also have this inane policy of making 50% dividend out of free cash. Why? I asked them why, and the answer was, that's what our shareholders want. I hate that answer, but that's what many of them say.
Wow.
So especially if you're in these industries that it's really a shame. Like in the telecom industry, they didn't reinvest in their business. I think where it really comes to problem, and AT&T is the same thing. If you don't reinvest in your business and you're paying a high dividend, that can lead to really bad consequences. Well, one area I've continued to find interesting, and I have since we started the fund, is Korea. There's some really interesting situations going on over there that seems to be a continuing unwinding and transactions happening in many of the firms there. We've been involved with a number of the situations where we've been able to make some pretty good returns, where in essence companies are restructuring, where they're taking, in Korea there's a lot of cross holdings. They take a lot of cross holdings, putting it into a holding company, and then the restructurings associated with that. One company I think in particular that's very interesting at this point is KT Corp, which is the incumbent telco. There's a number of things that are going on there. They own a large share in one of the largest internet banks in Korea, and the internet bank is basically going to be going public probably sometime next year. But the large one, Keiko Bank, which is their competitor, is also owned by another company. But in essence, what's happening is these companies that in Korea you have these companies that have a lot of different subholdings, and what's happening is a lot of them are now being spun out, because I think one of the key ways to remove the sum of the parts discount that a lot of investors see is basically for the companies to be spun out. And we're actually seeing some of that activity happening in terms of the restructurings of these businesses in Korea. And a lot of businesses, I think, and what gets me excited is basically that these actions are happening. And it's on a general basis, and it's an interesting time to take a look at that. So you get a combination of growing. The other thing about Korea, interesting KT in particular, and Korea in particular from telecom, is they're transitioning to 5G. So they're going to get in the next year or two, KT and SK Telecom, the other big player over there, is going to get a huge boost from 5G, because when you go from the current cell phone to 5G has the additional amounts of capability. It's going to basically get this Internet of Things. There's a lot of things that are really going to create some growth drivers within a business that traditionally has had low growth. So you're actually going from a low growth situation to a high growth situation of companies that have a lot of little pieces that could be spun off. So there's a lot of real, I think, latent value and catalysts moving in that direction. For KT as an example, but I think in Korea, I think that's an overall theme. I think what's going to happen going forward is that a lot of these businesses that have all these pieces, when they see what we've seen is that when these businesses have been spun off, there has been value creation, and when companies observe that happening, it's going to be sort of like a snowball. It's going to take one or two to start. The governments have set up the incentives correctly. Once the snowball starts going down the hill and people start to see, okay, my competitor did this and his stock price went up, then it'll be a herd mentality where more and more people will do it. And I think you'll see, like the United States had a lot of conglomerates in the 80s, and they deconglomerized after the 70s and 80s. You're going to see a similar thing in Korea, where a lot of companies are basically deconglomerizing because the market's going to say there's more value. So I don't know if anybody else has seen those kind of situations or incentives the governments have put in place to basically sort of make these businesses separate businesses to create shareholder value.
I see that in India, but I can't compare
Yeah.
the pace of change in India versus Korea, because I'm not invested in either one of those two countries. But I do see a similar trend of breaking up the conglomerates, creating value through that.
I think it's an interesting theme going forward for anybody that's sort of looking at these things, because in the United States, it created a lot of value when AT&T was broken up, and all these large companies, the breakup values become a very interesting theme. And I think it's just an area where, I think there's and from a disclosure perspective, Korea is pretty good. They disclose everything. A lot of it's in Korean, but you can get Google Translate and get close enough and just talk with other people. But what I'm noticing in Korea is a lot of companies are actually disclosing in English. And what that tells me is that if a company's disclosing in English, it's telling me that they want either
they want
American, they want external shareholders to know what's going on.
That's right.
And I've seen over the past few years the disclosures of very detailed business plans of what some of these companies are going to do, and that's been very encouraging, because it's saying, okay, because if you're in a culture like that where it's basically, if you didn't want them to know it, they could just keep everything in Korean, but they're actively going out doing stuff in English, and it makes a big difference. So.
Well, I wonder, are we seeing this in the U.S.? We haven't seen those types of spin-offs quite as much in breakups the last few years. And, I wonder, we've almost seen kind of reconglomeration in some cases. Now, with AT&T and Warner Media and things like that's maybe that's a high-profile case that might be happening as we speak. But I wonder where the cycle is in the U.S. relative. Are we behind or are we ahead?
Well, I've seen the U.S., they started out, there were a lot of conglomerates that were a lot of different things. In the U.S., I see the acquisitions really being more related companies, and those have a tendency to have a lot more synergies and are a lot more lasting. When you get companies that try to do these different business things, like AT&T tried to do with Warner, it seems to get quickly unwound, right? I mean, how long they didn't own Warner for very long, for 2 years. So it seems to be when those acquisitions of totally different businesses happen, they seem to get unwound pretty quick, and maybe that's just an indication that the companies in the United States are more sensitive to, okay, this business combination doesn't make any sense. Where in other places, in other times, they'll just keep it going, and eventually it gets broken up.
I think part of the issue is something that we addressed in the first question, which is the trend from a fundamental value standpoint. And back in the 80s, 90s, when this deconglomerization was going on, somebody like a Joel Greenblatt was able to take advantage of it, and he wrote a fantastic book about it. But then, as you said, Steve, the market sort of developed. Management teams sort of found out that there was an opportunity to spin off companies. But then they found out that they can actually put in a lot of debt into the spun off companies.
Right.
And that's where I think the trend has kind of gone off rail.
Right.
Because all these spun off companies come out with a lot of debt, and as a result, the opportunity set.
Yeah, there's a
from
good
these
co-bad
spin-
co situation, essentially.
Yeah, that's evaporated essentially. It's still happening, a lot fewer relative to what was happening, but that's partly because they're being dumped.
Well, we might see that with the Warner Media, Discovery, and AT&T if that goes through, because you've got a subset of investors who were in a stock for the dividend,
Yeah.
going back to the previous, and then the Discovery investors are certainly not. They're not in it for the dividend. So are we going to see a price depression when we get closer, to that acquisition closing, because a certain subset of investors are just getting out? Or are they going to get out in advance? We'll see. It'll be something interesting to follow, because you're going to have AT&T, right, retain their dividend, I would assume, or in some sense of it.
Yeah.
And the new company, highly indebted, you cannot imagine that they would be following that same capital allocation strategy.
But it's interesting, like you're saying, when you see in that acquisition, you see a recombination of common assets, right? Of assets that make sense. You'd say Discovery and Warner make sense; they go together. Warner and AT&T, what's the real synergy there? There's not a whole lot, right? I mean, the synergy. So you're seeing companies in the United States where the acquisitions are happening. They make sense. There's strategic reasons. There's synergies. There's hard synergies that can happen in those businesses, and strategic reasons for them to happen. And that's where most of the acquisitions I see in the United States are more of that type today. It's very rare to see.
Yeah, it's a pursuit of an oligopoly almost.
Yeah.
Right. So when you think about the competition there, now you have to be big to compete, and that's what they're doing.
Especially in media. Going back to that, I think that the idea of using media as a customer acquisition cost to acquire customers to sell something else, like in the case of AT&T, it was to sell broadband.
Right.
And a lot of these bigger companies, I think, have overvalued the return of the customer acquisition that they can earn from from making these large investments. But then you look at a company like Amazon, which is basically in one way doing kind of what AT&T did with Time Warner. They're buying MGM for $8.5 billion, and it's basically a CAC. It's a customer acquisition cost. They'll throw it into Prime, and they'll try to make Prime more attractive to ensure that you retain, that they can retain you, and so it's a retention game, a retention tool, and it seems to be working. Things like this seem to work better when tech companies buy more traditional businesses versus traditional companies buying tech businesses.
Well, yeah, it hasn't worked with Whole Foods though, and that's the kind of interesting element of it. You would put your money on Amazon making these things work, and we still have kind of a hodgepodge thing with Whole Foods and Amazon Fresh and Amazon Online. There's not been a very good integration there, and I wonder what the difference is and whether that's a solvable thing, or whether as time goes by, Amazon at their size and scale gets kind of stuck into the same issue that traditional companies have.
Absolutely. I mean, you have to wonder over time. Is it kind of we look back and it was no different than Amazon potentially is being just as irrational as AT&T was, thinking that they can integrate these things.
But if
it's going to make sense.
I think one of the big differences though is you look at what the two companies are selling. Right. Clearly, I think you can get more value in terms of what Amazon's selling versus what AT&T's selling, right?
Yeah.
AT&T's may be able to sell telecom services and that's
broadband,
broadband,
right.
and Amazon's selling
Prime
and everything else, right? I mean, so their product mix or their ability in terms of customer acquisition costs, there's a much broader base that Amazon can spread their customer acquisition cost across, let's say, versus
Right,
like
it's a
AT&T.
non-traditional conglomerate.
Yeah.
Exactly.
Yeah.
And I think for them, media for Amazon is a really good sort of a way, like you're saying, it's a attention drawer for them to get some additional business, and they've got other things that they can use associated with like AWS in terms of the hosting and that kind of stuff that can really add some add some value. It's an interesting
Yeah.
interesting approach, because it's versus like, and when the interesting thing is they're doing this stuff as a, what they're really doing is all the other guys in the media space are trying to monetize that. Okay, so you're basically have Amazon, where you're basically trying to compete against free, right, to a certain extent.
Yeah.
And so that's another dynamic where you've got some of the profitability of the other Amazon businesses subsidizing this thing and making it tougher for the competitors to really compete. But I don't know, it's an interesting.
Well, it kind of goes back to this idea, though, you know, for the most part in the U.S., we are conglomeratizing, and overseas, in certain areas, at least the areas that you two have discussed, you know, there's breakups happening. And, you know, why are these cycles different in certain countries compared to other countries, and when the interest rate environment's the same across the world?
I think part of it has to do with family control, right? I mean, the United States, there's not many big families controlling. If you look in Europe and Asia, you've got large amounts of family control. So that family control leads to this conglomeratization, because the objective of the family in terms of what their financial objective is different than the objective of the minority shareholder. So if you're a family and you own this business, you want to basically get diversification so that your family can be protected against the ups and downs. As an individual investor, you don't want that. So it's almost at odds in some of these places where family running of businesses can be different in terms of what their
Capital preservation, you know, more of a mode there.
Yeah, and so you look at companies like in Japan. I mean, they've been around for 300-400 years, some of these companies, because they're really good at capital preservation. They throw all the cash on the balance sheet and do nothing with it, basically just to survive. And that's the kind of mentality you'd see in a family business versus in a business in the United States, where you don't have shareholders that are like that their whole identity is based on the business.
Yeah, and when we think about the U.S. then and capital appreciation and those needs, especially in this market environment, you know, it obviously leads to a crypto discussion, right? Because you have all of this speculation here in the U.S. that isn't just in the market itself, but it's in these alternative quote-unquote asset classes, whatever you want to call it. So, you know, opinions?
We talked about the blockchain. The blockchain is really interesting, and will probably make things a lot more efficient and unlock a lot of opportunities in a lot of industries. One of the areas we're studying at JDP is the opportunity for the really big conglomerates to have a version of their own blockchain, a centralized versus decentralized blockchain. So, for the example of Diem, which is the Facebook initiation. So there were 27 companies that had signed up for the association. Now it's something like 27, and so Facebook doesn't necessarily own this blockchain, but the companies that have agreed to be a part of it own it, and they would use what's called a stablecoin, which is a U.S. dollar-backed coin. So the value of the infrastructure would not accrue to the currency owners, as it does in the way I understand it, as the case of kind of the Web 3.0, the Ethereum, whatnot. This would actually allow the platforms of the Web 2.0 to retain their value, but it's the mass market adoption potential of blockchain, at least the way I understand it, would come through regulated USD-backed coins that don't have any, that don't have any volatility. So, in the Diem Association would be a regulated entity, and there would be a stable coin in every currency, every major currency that you operate in, and you could potentially buy and sell, or you will be able to buy and sell things with your wallet within this group of companies that have signed up to be a part of it. So again, this is all new, and I'm sure we'll look back in 5 years, and this will be, I'll look like an idiot trying to fumble my way through, but this is something I'm interested in, but more so on how the mass market will adopt this and how that affects some of the companies that I'm interested in or maybe invested in today, versus the currency some of the cryptocurrency that's being used, which seems to be a much more of a speculative thing, and that seems very different from. It seems difficult for at least where it stands today to think of any asset that volatile having mass market adoption and 100% of people using a currency in a developed country that's going up and down 50%, in a month. But
Well,
again,
that's not
it's
currency, right?
Yeah.
I mean, they can call it that, but that's not what it is.
Well-
But one of the things that I think is interesting about the whole space is there were reasons why this bureaucracy, this quote unquote bureaucracy, came about. In between, there's a reason why there's T3, T2 settlement. There's a reason why wire transfers take so long. Why conversions into other currencies when you're sending money in. Like, there's a reason why there is this issue, and it's government regulation, right? So there's technological reasons. Those can be solved. That's not a problem at all. It's the know your customer stuff. It's the protection, the government protections, and the protections that banks have put into place. They slow down these transactions, right? So when you think about the blockchain, when you think about crypto stuff, they're removing, in many cases, those protections.
That's right.
Right, and
Those
there's going to be a
barriers.
backlash to that. Because this happens all the time, right? With credit card payments that were an error or in fraud or things of that nature, wire transfers that end up being not having, this would be kind of a transfer without having the proper protections in place. And, you think about this idea of the government protecting the little guy, and there are all these regulations in place to protect the unsophisticated person. Not just investor, but also all of these people in place to protect against fraud being perpetrated against the unsophisticated person. And these advancements that are happening in the blockchain and crypto space remove those protections. And it's just not going to stand long term. It's just not.
Well, and the work we've been focused on is just trying to understand the version of that is regulated, and the version of that could be adopted by the mass market, the version of that does make sense, that everybody agrees on. And
Well, give an example. Money transfers, right? Money transfers internationally. They should happen instantaneously.
Yeah.
They are able to with Bitcoin or something like that, or any other crypto, right? So right, when somebody makes a mistake, there's a reason why wire transfers of a significant size need bank approval. It's to protect against those mistakes. And so then that allows recourse if an error is made. But these crypto payments, there's no recourse, right? And that is a problem for unsophisticated people, and there should be a protection from the government and industry for those problems. So for anything related to fraud or other errors by unsophisticated people. And so I don't, we'll see how this all shakes out. And, for us and for probably most of the viewers here for this video, it makes sense. Like, we would love to cut out, and have immediate approval to, and the markets now have T2, and we can cut out a lot of the bureaucracy and the overreach that regulations have had. But you don't want to do away with it completely.
Well, and I think there's some other good practices that have come from these. I mean, some of these, for example, as a result of all this crypto stuff, let's say these cryptocurrencies don't end up anything, but you do get some good practices. Like, for example, there's some networks where basically there's mutually owned networks. And that's a very interesting concept, that right now the network is owned by someone and they get a proprietary percentage. Well, there's concepts that were basically born out of the crypto types of ideas and exchanges, where right now you can be a network participant, and then you get some of the economics of that in combination with the shareholders, in combination with the employees. So there's these types of ideas, I think, that crypto is broader than just crypto, but I think they're the types of ideas and concepts that really can be applied in other places, even if crypto turns out to be a bust in the end, right?
Right, because if you look back at the original internet, I mean, things have evolved obviously very different than you probably could have predicted in the early 90s and the mid 90s, and so I think this is just the beginning of an evolution that will evolve pretty materially over time. And to your point, it will have to make sense for everybody, for the little guy, for somebody like my mom has got to feel comfortable using a digital wallet that's custodied, that the currency isn't volatile.
And I think all of this comes about because of regulatory overreach, and this is regulatory arbitrage. And it's the same thing why Uber and Airbnb, right, were able to, in many ways, flout the existing laws, right, and until they got enough scale, and then the laws were changed. And that's kind of what's happened here as well. And I think it is an improvement. It is a good thing because there was overreach and regulation, and this is a way for the government to be kept in check. Quite frankly, for there to be a little bit more of a libertarian-ish world because the protections went too far. But my point is that there will be a backlash, and so I think we have to be aware of this, not just with like investing in crypto directly, but in some of these initiatives. We need to keep things into perspective and keep the enthusiasm into perspective. When you look at valuations, certainly if an Apple, right, can borrow sometimes in negative rates overseas, but like say 1% or so in the U.S., and what multiple should they trade at then if their reinvestment opportunity is beyond that? And so, in this environment, assuming interest rates, and this is a big assumption, are going to be stable, assuming the 10-year, is somewhere around 2% or something like that over an extended time period, then free cash flow multiples of any reasonable company should be 50 times plus, right? It's not quite that yet, and for good reason, because the stability, I don't think we can rely on rates not rising anytime soon, and that inevitably leads to a judgment about inflation. So, I think in the U.S., we've seen some obviously big inflation in the last few months. Whether it's going to be transitory or not is a good question to have, but you're not seeing that inflation in Europe.
No. Well, not officially, and each country is different, but where I live in the Netherlands, you're penalized by having cash in the bank. You pay a negative interest rate. For example, I had some cash in a short-term trust. We were buying a home, and I think we had to pay hundreds of euros just to hold it for a week or something.
Wow.
So there's negative interest rates are really detrimental to the average person, and in Europe you have a lot of average people financially. It's a middle class oriented thing, so it's hard on savers. It's hard. It punishes the saver, and if you don't have a culture of investing, it's I think potentially could have some really detrimental effects longer term. But to your point, I think things look. I don't know who would buy a negative interest rate bond, who would buy a negative interest rate bond in Germany or
banks, because they'd be required to.
Yeah, and
so
and insurance company.
And insurance company, right?
Yeah, of course they're required to, but you wonder what are the long-term ramifications of that? There's so many incredible businesses to invest in Europe. Even if you're not looking for growth, you're just looking for just something stable or even a small dividend or it seems like there's so many great alternatives, but. Where I've seen inflation personally is, for example, in real estate. In Amsterdam, prices have just skyrocketed because it's just so cheap to borrow, and there's other reasons for it. And during COVID, the borders were effectively closed to non-EU citizens. There's no tourism. It's very difficult to come over for business, for example, from the U.S. And house prices have just gone insane because you can borrow money.
Yeah.
What's the interest rate? What was your interest rate?
Well, about 1.3%
on your mortgage.
Yeah.
How many years?
Well, it's a 30-year AM.
And what percentage did you have to put down?
Well, in my case, I put down a lot because I don't have a European income. So, but a typical, a local person with a local contract may put down, 5 or 10%.
At 1.3% interest.
And look, and that's there have been times where during peak fear when it was lower than that, and then now it's probably a little bit higher. Maybe it's 1.6 or 1.7 or something like that. But just you see the appreciation in real estate, and again, there's other factors driving that, other tax consequences. There were some incentives by the government for example, people under 35 to buy, and it avoided some local city taxes or whatever. But you can if you look at a chart of the appreciation in Amsterdam real estate compared to the interest rate, you see it's very much correlated. And you wonder, I mean, clearly the people that can afford to make the investment and buy a home have benefited enormously from it. And the people that can't afford to do it have been kind of left behind. So it's creating some wealth dispersion in a country that looks down on that and tries really hard to minimize that discrepancy.
Mm-hmm. That's exactly the whole issue, though, with Fed intervention, not just Fed intervention, but like internationally as well, where you have low interest rates, it separates.
Yeah.
It makes that dispersion even wider between the have and the have-nots.
And I guess the real question is if you're looking at it from the long rates are also low. So what that's telling me is that maybe what's really going on is there's deflation in the system, and because the long rates are still relatively low. I mean, they've increased recently, I think, with a lot of the spending plans, and what we may actually see, which is going to be something unusual, where the steady state is a small amount of deflation, and any positive interest rates are really high real rates that people are paying in countries. And if that's the case, that's what caused the Great Depression, right? I mean, the Great Depression was caused by large amounts of deflation, and interest rates slowly going up. So the real interest rate going into the Depression was gigantic. And as the governments spend more money, I think you see it in the United States when all these plans, when Biden came out with and it basically said, okay, we're going to spend all this money, that's when the interest rates went up. And I don't think it was because they think inflation was going to go up. I think it's because people said the real rate that we're going to lend to the U.S. is going to go up. Mm-hmm. And it's two different reactions to that, right? Yeah. I mean, if you think that people are going to charge you higher real rates, that's a real issue, and that's going to cut back on the amount you're going to borrow. If you think that it's basically due to inflation, then that's not going to have that effect. But I think what it may actually be is because the things that drove us to reduced inflation and deflation, I think, are still in place. I don't think those things have changed, right? I mean, you have the issues of technology constantly reducing the cost of goods for the most part. Those long-term trends, although they may not be as fast due to some of the changes, those trends I think are still in place. And what will really cause what you're seeing now, the prices going up. The prices are going up due to shortages.
Yeah, that's right, and that's the transitory part that the argument comes from, because the supply chain was shut down for so long. So I think this is one of the reasons people view some of these things, some of these commodities going up as transitory. But for example, in Europe, you're not seeing wage inflation at all. Mm-hmm. If anything, you're seeing wage deflation. Technology is absolutely reducing taking costs out of the system. Yeah. There was somebody sent me an article the other day saying that traditional kind of smokestack type businesses are now spending more on software than a lot of their budgets of software have come to an all-time high. And you're going to see as that plays out that the companies become more efficient. Even traditional businesses will become more and more efficient. And a lot of times, the impact of technology is underrated.
Like you had mentioned before, the whole blockchain technology. That's going to think about all the costs that's going to reduce out of the system. Yeah. For basically transferring stuff back and forth. That's just one example.
And how much it will increase, though, the energy usage, which is an offsetting expense.
But energy to a certain extent. Well, no, if you're doing crypto mining, though.
No,
right?
no, not just crypto mining, but blockchain in and of itself. Because if you're talking about kind of authentication across a number of different avenues, if it's not centralized, if it's decentralized, you're talking about then inflationary things on computer chips, on energy usage, on et cetera, et cetera.
But I think overall energy usage, even though it's popped up, will continue getting cheaper and cheaper. Just take a look at the solar cells and the renewable stuff. That stuff's I think if you look at it, there's blips along the way, but the cost of energy over time has just collapsed. And I think it's
why is that?
Because of technology advancements. That's what's really caused it. So you've gone from you started out as wood, then you went to coal, and then you went to oil, and now we're going to solar. Each generation has created cheaper and cheaper energy, and that's why we don't need as many people. Whereas before, to get stuff done, you needed people. Basically, that's how you built civilizations, was by having lots of people, not any machines. And so basically, that was the currency. But if you say, well, how many people does it take to build something now? It's gone way, way down because energy's just gotten so cheap.
Well, the cost of renewables is definitely going down. I mean, the cost to build a solar farm or the cost of wind Wind energy has declined.
And you'll continue to have that.
Dramatically.
It's just like, you know.
But it was initially subsidized by governments to get it going, but it seems like the cost to build and the cost to transmit has come down from what I've read. I don't know how attractive it is relative to, you know, the past. In each country, it varies by country, but it seems that, you know, from, I don't know, maybe it's just the kind of companies I'm invested in. I definitely see the winners are taking costs out of the system, and they're making something more efficient for the consumer. Yeah. They're adding value, they're reducing friction, and they're taking costs out of the system, and they're doing it better and cheaper, which is why they're not only surviving but thriving. And they're not just producing some widget that they can increase prices on, like a See's candy, for example. It's something that's that the addressable market is growing, and they're taking out costs. And so I don't want to state that. It just happens to be the world, the area that I'm focused on. But
I think if we invert that, that's where you're going to get inflation. If these trends start to reverse, now how could they reverse? One way could be if there's a massive war that destroys a lot of the infrastructure. Okay, we hope that doesn't happen. But when you look through history, when has inflation happened? It's when there's been destruction, either through war, famine, or epidemic. And hopefully that won't happen. If it won't happen, you're still going to have this huge deflationary sort of tailwind that's just going to keep on going.
Okay, so to put a capstone on this, let's go around the room here and say what type of thing do you look at or invest in that protects you for both sides? Right, both inflation and deflation. Is it a sector? Is it a particular type of company? Is it, some sort of asset class? What do you do to protect yourself either way?
I think one way you can look at it for companies that have really strong market positions where they can raise prices. That's one asset. Another asset class is if you've got. I mean, I like triple net lease type stuff because you can have CPI plus inflation associated with those, and so basically what that creates is you have like an inflation adjusted bond, in essence, is what you're getting. If you can find any asset that generates an inflation adjusted bond type of cash flows, those are going to be really good assets. You look at like tips are at negative yields now because they're so favorable, that have those characteristics like you're saying. There's huge demand for those things, and those are the types of assets I think that would do well in either case. I mean, because the tip is okay. You know, if the inflation goes up, you're basically you do well. If inflation goes down, I think you do well too, and that's the ultimate, I guess, risk-free asset per se.
So. Shree, Jeremy?
Yeah, for me, I need to have an affirmative answer on 4 questions. To answer your question, I'd say I need affirmative answers on 4. Number 1, do I understand the business? Pure oil and gas, Bitcoin, biotech, those fall outside my circle of competence, so I stay away. And to answer your specific question, can they actually raise prices? I try and figure out if it's a monopoly or an oligopoly. Those situations, they are able to maintain the pressure, take the pressure and maintain their pricing, or pass it on very successfully. So that sort of answers the question about inflationary headwind. And then the third question is it run by a good quality management team with integrity? I want them to have good skin in the game, good alignment of interest, and then available at a reasonable valuation. That's my 4th question. So with those 4, I kind of remain consistent across different inflationary, deflationary kind of periods, because I'm focused on only a handful of businesses. I spend a lot of time trying to understand the impact of inflation, interest rates, everything associated with the macro, and I try to keep it simple that way.
Very good. Jeremy?
I mean, I generally don't invest in cyclical businesses, and I'm looking for businesses that can grow. And I think growth is really the only way you can outrun any of these problems. You think about the famous letter Buffett wrote about inflation. He talked about the return on capital at a company like some of the companies he profiled compared to where interest rates were. And the reason those stocks were flat for so long in the 70s is because they couldn't earn a return that was necessarily outpacing inflation. And so it's a question of growth. and the addressable market also growing. And so it's a combination of those two. And of course, a lot of times you find it in founder-led businesses where a management team has the ability to make long-term decisions and long-term capital allocation decisions that probably are not appreciated in the short term.
Right.
And they don't necessarily have to be founder-led. I mean, that's kind of a bit of theme for the last few years, these founder-led businesses, because they've done so well. But there's a lot of businesses, like, for example, Target's not led by the founder, but it's an incredible CEO that's made some just phenomenal long-term investments that are now starting to pay off in e-commerce, for example. And I think that's what I look for. I look for, we just have a really long runway to grow multitudes faster than whatever inflation could be, relatively speaking, within reason. And it's a combination of an addressable market growing and the business's characteristics getting stronger and stronger over time. And so I think to your point, you have to know that business really, really well and focus on it, because I'm not sure you could develop that conviction, the conviction you need in a difficult time. I'm not sure you could develop that conviction over 30 businesses or 20 businesses.
Right.
An extreme focus on 4, 5, 6 businesses, and not necessarily concerned about how they're doing today, but how they could perform longer term is what it takes to develop that conviction. Doesn't mean you'll be wrong. It's just that it's that focus on really being able to understand it. So
Yeah, and I'll echo that, in the sense of you need to invest in intellectual capital, right? And so when you're finding a company that, the industry in and of itself is, some industries are going to be better in inflationary environments, some better in deflationary environments, et cetera. But if you're going to concentrate into a particular company, you have to appreciate the qualitative aspects of the decision maker there. The capital allocators have to be excellent. They have to have the ability to recognize what's going on in that particular environment, when to really put the pedal to the metal, when it should be, and when to step back when it should be step back. And so, you look at all of those same things that you've mentioned in the industry and everything associated with that, and then layer on a really, really great capital allocator.
Yeah, I would echo that. In the short term, I think valuation becomes important. Short term is maybe even less than 2 years, 3 years. But in the longer term, it's the culture.
Yeah.
It's the the people running the company having the motivation to kind of continue to develop that culture. That becomes a lot more important.
And that's exactly what each of you said.
Yeah.
Each of the examples that you made, you touched on that also. The thing with Target, for example, is it has the culture of that founder.
Yes.
Right, and that's what they're implementing. So, but I want to thank each of you for being on here. I think it's been a great
Thank you.
discussion,
Yeah.
and I've enjoyed it quite a bit. I think our viewers here will really find a lot to appreciate out of it. So thank you for being here.
great hanging out.
All right,
Thank
thanks.
you.
Yeah, thank you. Yep.